Are recession fears being driven by the media? Let's find out.
Joining us are top economists like Danielle DiMartino Booth, whose sites are crucial at this moment.
We've distilled their analyses into quick, powerful summaries that save you valuable time.
Buckle up, Danielle kicks us off with her take on how media narratives shape economic fears.
Today, we're discussing the analysis of economic fears presented by Danielle DiMartino Booth.
Danielle highlights the primary concern that rising media narratives on recession fears could become self-fulfilling, potentially deepening economic hardships already felt by many.
Danielle asserts that the current economy is more fragile than advertised, with many consumers already feeling recession impacts.
She fears that if the media aligns behind recession narratives, it could lead to widespread panic and economic contraction.
Danielle notes that the media has the power to shape public fear regarding economic downturns.
If recession fears grow, consumer spending could retract further, complicating economic recovery.
Danielle draws parallels between today's economic conditions and past Federal Reserve policies.
She highlights the importance of not repeating past mistakes that could lead to economic upheaval.
Danielle emphasizes demographic changes affecting the economy, particularly the aging population.
The trend toward multi-generational living may help alleviate immediate housing market pressures.
Looking ahead, what does Danielle say about further economic contraction?
Danielle warns that unless significant changes occur, the economy might face a pronounced downturn with rising unemployment.
Danielle advises viewers to remain cautious and informed as economic conditions evolve.
She suggests that individuals leverage family networks to create a financial safety net.
Today, we're examining George Gammon's discourse on the significant warning signals coming from the Treasury market.
George articulates these signals and their potential to redefine our economic outlook.
George Gammon argues that the recent surge in Treasury yields reflects increasing worries about government debt.
He explains that higher yields typically indicate investor hesitation related to inflation expectations. According to George, the 10-year Treasury yield surpassing 4.5% serves as a crucial alert for investors.
This trend suggests a declining confidence in government fiscal management. George points out that the extensive growth in Treasury supply has led to market imbalances.
When demand decreases as supply rises, yields invariably increase. George highlights how ballooning national debt necessitates refinancing at heightened interest rates.
This cyclical issue exacerbates strains on fiscal policy and market stability. What does George project regarding the trajectory of Treasury yields?
He foresees that if yields continue to ascend, significant reactions from financial policymakers could ensue to steady the markets.
In conclusion, George emphasizes the importance of informed investment strategies amidst these evolving Treasury signals.
Monitoring the interaction between yields and broader economic health will be crucial for future financial planning.
Today, we delve into the insights provided by the Trade Brigade team about bearish divergences in the Nasdaq and effective trading strategies for Tesla.
Understanding these patterns will help traders position themselves effectively as market dynamics evolve.
The Trade Brigade team reports that the presence of bearish divergences in the Nasdaq could hint at potential market pullbacks.
Such divergences raise doubts about the persistence of existing bullish trends.
The Trade Brigade stresses the need to keep a close eye on significant support and resistance levels.
As market sentiment changes, traders must stay alert and prepare for potential reversals. According to insights from the Trade Brigade, knowing Tesla's breakout levels can offer valuable trading opportunities.
Given the high level of volatility, formulating a solid strategy around these levels is critical. What are the Trade Brigade's predictions for the Nasdaq as we look ahead?
They recommend that traders remain vigilant for possible corrections as bearish indicators become more evident.
In summary, the Trade Brigade suggests that traders adapt their strategies to align with the current market conditions.
Maintaining a strong emphasis on technical analysis is key in navigating the market's potential volatility.
Today, we're discussing the current challenges facing the Florida housing market with real estate expert Phil Simonetta.
Phil highlights a staggering 75 to 80% drop in migration to Florida and rising living costs affecting potential homebuyers.
Phil notes that the decline in migration to Florida is directly affecting home sales, with many new residents leaving due to rising costs.
Indeed, many potential buyers are now reconsidering their decisions because high taxes and insurance costs are taking a toll.
Phil explains that many are leaving because the cost of maintaining a home has become too burdensome, with insurance rates sometimes surpassing $6,000 per year.
Absolutely. And when families are spending 60 to 70% of their income just on housing costs, something needs to give.
Phil discusses the changing culture in Florida, highlighting that it's becoming less family-oriented, which deters many potential buyers.
And with fewer families moving in, we see a notable decline in the birth rate, which could have long-term implications for schools and communities.
Looking ahead, Phil predicts a substantial correction in the housing market, similar to historical trends.
Indeed, as costs rise and demand dwindles, we could see home prices decrease significantly over the next few years.
Phil suggests we may be on the brink of a significant market correction, one that many have been anticipating.
If current trends continue, we could witness price drops mirroring those of past market crashes.
Phil emphasizes the pressing need for greater accountability within the real estate industry to protect consumers.
Indeed, as buyers become more informed, they might find that they can handle transactions independently, reducing reliance on traditional real estate services.
Today, we'll analyze the housing market downturn in the Southwest, as discussed by Nick Julie from Reventure Consulting.
Nick highlights how states like Arizona, Nevada, Colorado, and Utah are all facing significant challenges.
Nick Julie emphasizes that inventory has surged significantly, putting downward pressure on prices.
He notes that home values are already falling, with decreases of up to 7% reported in certain areas since mid-2022. Nick details that Arizona currently has over 30,000 active listings, a level not observed in a decade.
That's remarkable. Isn't there a similar situation in Las Vegas?
Absolutely, Las Vegas shows a year-over-year increase of 60% in homes for sale.
So how does Nick characterize homebuyer demand?
Nick explains that demand has collapsed, now at its second lowest level in Phoenix in over 13 years.
What predictions does Nick make regarding future home prices?
He anticipates price drops ranging from 4% to 9% across the Southwest in the coming year.
Nick forecasts that Arizona will experience a 4.9% decline in home prices over the next year.
He adds that Colorado is expected to mirror this figure, indicating a challenging year ahead for buyers.
In conclusion, Nick underscores the importance of leveraging data in this evolving housing market.
He encourages potential buyers to stay alert to price changes and inventory adjustments, as these will influence market dynamics going forward.
Today, we're exploring the latest market insights with Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com.
Chris identifies key factors affecting equity markets and addresses the current bullish sentiment.
Chris Vermeulen argues that the recent rise in markets may be a false signal, a dead cat bounce.
According to Chris, despite indicators showing a recovery, the underlying market conditions remain weak.
Chris elaborates on the concept of a dead cat bounce, which he describes as a short-lived rally in a bear market.
He warns that this could lead many investors to make hasty, optimistic decisions.
Chris highlights the potential traps investors face with dividend stocks, often viewed as stable.
He indicates that during periods of market instability, these stocks can suffer substantial losses.
What does Chris predict for the market moving forward?
Chris anticipates increased volatility and major corrections, suggesting investors need to be vigilant.
Chris expects that the current market euphoria may soon be followed by corrections.
He advises investors to maintain a defensive approach and be ready for downturns.
Chris concludes that being cautious during bullish trends is essential for long-term investment success.
He encourages investors to evaluate their strategies and be wary of the risks ahead.
Wow, what an enlightening discussion we had today.
Absolutely. Each guest brought something truly valuable to the table.
Chris Vermeulen's warning about the potential dead cat bounce definitely caught my attention.
Right? That perspective really underscores the volatility we're currently facing in the markets.
And then Nick Julie painted a pretty grim picture of the housing market in the Southwest.
Indeed. His analysis on inventory spikes and price declines seems to echo a broader issue of economic instability.
Phil Simonetta highlighted the situation in Florida too, suggesting a potential market correction.
Totally. And I found it intriguing how he linked migration trends to housing demand.
Then there's the Trade Brigade team, focusing on bearish trends in the Nasdaq, particularly with Tesla.
Exactly. Their strategies seem quite timely given current market fluctuations.
George Gammon brought a different angle, emphasizing the connection between rising Treasury yields and economic risks.
That's right. His insights into government debt versus interest rates really add depth to our understanding of market dynamics.
And let's not forget Danielle DiMartino Booth's warning about a self-fulfilling recession prophecy from media narratives. That was chilling.
It really was. She's calling for careful government interventions to help stabilize the economy.
If you found these discussions insightful, please like and subscribe to keep up with our future content.
Your support helps us continue to provide expert analyses that can inform your financial decisions.
Be sure to tune into our next episode where we'll tackle global trade dynamics.
You won't want to miss it.